Morning students, I welcome you all for the online class of economics. Today I will be going to explain you once again the topic, that is the fiscal deficit. As the student want to learn more about the fiscal deficit, so I will be going to learn explain you the fiscal deficit meaning. Fiscal deficit, when we say student, it is the deficit which arises just because the taxes, what the tax government have to incur, what the tax government have planned to take, that they are not able to achieve, that is known as fiscal deficit. Fiscal deficit is estimated accounting for both revenue as well as capital receipt and expenditure of the government. Fiscal deficit is excess of total expenditure, that is revenue plus capital, over total receipt, that is revenue plus capital other than borrowings. Example, it is estimated as under. Very first, fiscal deficit equals to total expenditure, revenue expenditure plus capital expenditure minus total receipt other than borrowings. Revenue receipt plus capital receipts other than borrowings equals to fiscal deficit equals to budgeted expenditure minus budgeted revenue other than borrowings. When budgeted expenditure greater than budgeted revenue other than borrowings, here it comes. Here fiscal deficit. So what in the same one line meaning? Fiscal deficit means the total expenditure which we incurred, that is a revenue plus capital in nature, minus total receipts rather than borrowings, that is the revenue receipt plus capital receipt. It is known as fiscal deficit. Fiscal deficit is estimated as the difference between total expenditure and total receipts other than borrowings. Borrowings will not be treated as gross fiscal deficit. Okay. As there are three sources of borrowing from the government, gross fiscal deficit is also estimated as under. Gross fiscal deficit equals to borrowing from Reserve Bank of India plus borrowing from home, net borrowing at home, borrowing from abroad. When we will add up these three, it will consider as gross fiscal deficit. It is not estimated. Okay. Gross fiscal deficit shows estimated borrowings by the government to cope with its expenditures during the year. Often it is expressed as a percentage of GDP. This is estimated as excess of government expenditure over government receipts other than borrowings during the year. In terms of sources of borrowings, it may be estimated as borrowing from Reserve Bank of India plus borrowing from abroad plus net borrowing at home. What are the implications or result of this gross fiscal deficit? The fiscal deficit is an estimate of borrowings by the government. Greater fiscal deficit implies greater borrowings by the government. Implications of fiscal deficit are as under. Very first, it shows inflationary gap spiral. Borrowing from Reserve Bank of India is an important component of government borrowings. This increases money supply in the economy. Increase in money supply leads to increase in the general price level, and a percentage increase in price level will make the low demand of the goods over a period of time. Because as the income of the people is not increased, same way in other way the price has been increased of the goods, which will result in inflationary spiral. It is like way. What is spiral? Again and again the same situation is arising. From where it has been started, we are coming to the same again. But that is known as spiral. Inflationary spiral means again and again the demand of the even sudden increase in the income of the people, small increase in the income will increase triple times and 4 times the prices of the goods that people cannot afford for the same in the future period of time. That is known as inflation. It is like wage price spiral. Wages catch prices and prices catch wages. This hinders the process of growth as it raises the cost of raw material, the cost of credit for investment, the rate of interest, and the cost of labor wage rate. So, mounting debt for future generation. Recurring borrowings mount up national debt for future generations. Future generation inherit a laggard economy where its GDP growth remains persistently low. This is because the repayment of loans consume the bulk of surplus year after year, and domestic investment continues to be low. So that is the mounting debt for future generation. What happens for the mounting debt for future generation? Recurring borrowings mounts up national debt for future generations, and future generation inherit a laggard economy. What is laggard economy? The economy which is not able to achieve the target, not able to earn the income, it is known as laggard economy. Very backward from the economic point of view. It is known as laggard. So future generation inherit a laggard economy where GDP growth remains persistently low. because of repayment of loan. Has this situation, inflation situation, what will be doing? This will make the people to rely on the debts. Why? Because has the small income increase, people think they can afford everything. They are thinking that they can take the loan and they can fulfill their desire and needs. Okay, not the want, their desire and the needs. And in that situation, what happens to them? What they do, they will take loan, and in the future time, what the income they will be earning, that will be going in payment of the loan what they had taken. Years and years it will be doing like that. So that situation, what will be doing? It will mount debt for the future generation. Recurring borrowings mount up the national debt for future generation. Same with government, if they are not able to get the fiscal tax money in the form of revenue, they will not be able to fulfill the commitment what they have did. They cannot be able to fulfill the expenditure what they have committed. So what will be done? They will be full of debts. In that situation, the government will take the loan and they will be trying to repay, and in the future generation the government will be in the so debt that future generation what the government they will be getting, they will be indebted. So this is because repayment of loan consume the bulk of surplus year after year, and domestic investment continues to be low. Vicious circle of high fiscal deficit and low GDP growth. Persistently high fiscal deficit leads to a situation where GDP growth remains low because of high fiscal deficit, and fiscal deficit remains high because of low GDP growth. Okay, so what we are seeing there, the continuously, persistently means continuously when we government is getting fiscal deficit, they are not able to year after year the tax, the people are not tax imitation they are doing, they are not paying the tax on the given time. What will be there? Revenue of the government will be decline year after year, and the expenditure which the government have to make toward the welfare of the society, they will not be able to do so because they are not having enough revenue for doing so. So what will be there? High fiscal deficit and will lead to low GDP growth, as the government will not be able to make the development of the nation. They will not be able to make the people employed in such a rate how it has to be done. GDP growth remains low because of high fiscal deficit, and fiscal deficit remains high because of low GDP growth. High fiscal deficit causes low GDP growth basically because of two reasons. High fiscal deficit reduces investment expenditure by the government on infrastructure expansion in the country. This erodes the inducement to invest. When fiscal deficit has high rate of taxation also remains high, this reduces disposable income of the people. Consequently, aggregate demand is reduced. Low aggregate demand acts as a serious roadblock in the process of production activity. On the other hand, low GDP growth leads to high fiscal deficit because low GDP generates low revenue for the government, particularly in terms of tax receipts, and low GDP implying that a large segment of the population is between poverty line. Below the poverty line, not between, it is below the poverty line, raises government expenditure on food subsidy and welfare programs like Manrega, etc. for the benefit of below poverty line population. So that low GDP is not good for the country, not good for the society, because low GDP implies the underdevelopment of the nation. Development is stagnating, the stagnant development of our nation, that will be showing. So that is not to be shown. So low GDP implying that a large segment of the population is below poverty line, raises government expenditure on food, then the subsidy and welfare programs like Manrega and for everything. That by this program Manrega, Mahatma Gandhi national programs, what will be happening there? The people will be, this program is having many types of job opportunity for the people, even for the labor till the high income group people, they are having the opportunity of job. What job? Like BDO, block development officer, then the labor 100-day wage, many things are there implemented by this Manrega so as to make the people employed, so that they can earn the income and per capita income of the people can increase. Thus, in case the situation of high fiscal deficit and low GDP growth persists a longer period of time, we are almost caught in a vicious circle wherein high fiscal deficit and low GDP growth start reinforcing each other. Crowding out. High fiscal deficit leads to crowding out effect. This works like this. High fiscal deficit leads to high borrowings by the government. Definitely the borrowings of the government will increase. When the government will be indebted, you can think about the particular nation whose government is indebted. High borrowings by the government from the money market reduces availability of funds for private entrepreneurs. If government will take the loan from the market, from where the private sector will arrange the finance for their business. So because finance is limited, it cannot be supplied to all the peoples at the equal time. So if the government is indebted and they are taking loan for fulfilling the indebtedness, from where the private sector will get help, from which source they will be collecting the money so that they can continue their business. So that is a question, that is crowding out. Drought of funds in the market leads to high rate of interest, and drought of funds along with a high rate of interest lowers the level of investment in the country. The economy slips into a state of economic slowdown. Erosion of government credibility. High fiscal deficit and consequently the mounting national debt erodes credibility of the government in the domestic as well as international money market. Credit rating of the government and the economy is lowered. Global investors start withdrawing their investment from the domestic economy. Demand for the domestic currency start declining. Exchange rate start appreciating. Import become expensive. Government expenses on imports like import of oil in India start picking up. We start importing inflation along with the import of goods and services. Domestic investment is eroded. Definitely domestic investment, because whatever investment we have doing, it is going to outside country. So in that way, if we are seeing, it is very wrong with our nation's development. The government is left with no option but to open up domestic market for foreign investment. The economy may take a kick start but not without surrendering economic control to the foreigners. So that is erosion of government credibility. The government will not be able to give credit facility to others like farmers and others. They will not be able to help them because they are themselves eroded with that government credibility. Global investors start withdrawing their investment from domestic economy. Definitely in which country the government is taking loan and indebted, there are credit and credits of the government. Definitely no investor from the foreign country will like to do investment in our country. Our domestic investment will be only in our country. People will not, foreigners and foreign investment, they will not be liking to do any business and any investment in our country. Government expenses on imports like import of oil in India start picking up. We start importing inflation along with the imports of goods and services. Definitely prices of goods and services which we are importing from outside country, it will automatically increase many times because our country is suffering from credit. So in that credit based country, no one will be trying to invest, and when the investment will be there, foreign investment will not be there. Definitely the prices of the foreign goods will be more as compared to our country's goods, because demand and supply depends on prices of the good depend on the demand and supply of the goods. If demand is lowering of our country's goods, definitely its price will also lower down. And when demand for foreign countries' goods is increasing, definitely its price will be increasing as many times. So in that situation, government will be more indebted. Now comes a primary deficit student. When we talk about primary deficit, it is the large deficit difference between the fiscal deficit and interest payment. It is estimated as under. When we talk about primary deficit, it equals to fiscal deficit minus interest payment, PD equals to FD minus IP. Here primary deficit and fiscal deficit and interest payment, that is a full form of PD, FD and IP. While fiscal deficit shows borrowing requirement of the government, definitely when the revenue of the government is less gain as compared to actual, definitely they will be trying to borrow the money from the market. Maybe the national market or international market. Inclusive of interest payment on the accumulated national debt will be increasing of the government. This will show primary deficit shows borrowings requirement of the government exclusive of interest payment. Okay, fiscal deficit shows the borrowing of the government with interest payment, whereas primary deficit shows borrowings requirement of the government exclusive of interest payment. In other words, primary deficit indicate government borrowings on account of current year expenditure and current year receipts of the government. Implication of primary deficit are similar to those of fiscal deficit. The only difference that primary deficit does not carry the load of interest payment on account of the past loans. Primary deficit just indicates borrowings, means the principal amount, what they had taken, government taken, not the interest payment beside that payments. Current year expenditure greater than current year revenue. What does zero primary deficit mean? The zero primary deficit means the government resort to borrowing only to clear the existing backlog of the interest payment. It is not adding to the existing loan for the purpose other than meeting its existing obligation to interest payment. It is a sign of fiscal discipline or fiscal responsibility on the part of the government. High primary deficit, on the other hand, reflects fiscal responsibility of the government. A government budget shows a primary deficit of rupees 6900 crore. The revenue expenditure on interest payment is rupees 400 crore. How much is the fiscal deficit? What is the formula of fiscal deficit? We have seen fiscal deficit equals to primary deficit plus interest payment. As we learned now only. Whatever primary deficit includes only the principal amount, it not includes the interest payment. So fiscal deficit, it includes the interest payment with the principal. So here primary deficit is shown in which we will include the interest payment, then it will equals to fiscal deficit. Okay, now the question arises, how can the Gulf countries capital expenditure and capital receipt be reduced without borrowing? Suggest two ways. The government can resort to this investment, selling its stake in public sector enterprises. The government can sell its surplus land. The two options are there, as we also do. How can the gulf between the capital expenditure and capital receipt can be reduced? The two ways are there. If the capital receipt is less as compared to capital expenditure, then government can resort to what to do? This investment. That is selling its all the shares in public sector to private sector. Second thing is that whatever assets government is having, that is the surplus land or anything, they can sell off it to the private sector, so has to be at the credit. Can there be a fiscal deficit without a revenue deficit? Yes, it can be, because revenue deficit is the deficit which arises when the income of the government is less as compared to the expenditure. So fiscal deficit only the taxation part. Revenue means all the type of tax and non-tax receipt. Fiscal deficit includes only the tax receipt, because fiscal deficit is worked out by accounting for both revenue and capital receipts and expenditure of the government, so that even when revenue receipts and revenue expenditure are in a state of balance, there could be excess of capital expenditure and capital receipt causing fiscal deficit. As fiscal deficit, total expenditure and total receipts are taken. So in the total receipt, what is taken? Capital expenditure, total receipt, that is the capital plus revenue receipt, whereas in the total expenditure we take capital expenditure plus total revenue expenditure, whereas revenue deficit is only taken revenue expenditure minus revenue in receipts. So revenue deficit include only the revenue parts. Okay, revenue deficit and revenue receipt and revenue expenditure, whereas fiscal deficit include the total receipts and total expenditure. So total expenditure includes capital also with the revenue, and same way total receipts also include capital plus revenue receipts. So here fiscal deficit is more than the revenue deficit. Revenue deficit is a small part of fiscal deficit. Here one question is there, an illustration on the estimation of various types of budget deficit. The illustration is based on the following set of data drawn from Union Budget 2013 and 14. Provisional debt on the budgetary status of the Government of India 2013-14. This has been taken. Item rupees crores. Revenue receipts 10,56,331. Revenue expenditure 14,36,000. This way they had been shown. Source Union Budget 2013 and 14. Using the estimation procedure, total receipt is given, total expenditure is given, how it has been calculated, that also written there. Recovery of loan and other receipt is given, borrowings and other liabilities given, interest payment given separately. As in the primary deficit, interest payment will not be added up, so it is given separately. How we will calculate the three deficits? First, revenue deficit. Revenue deficit, the formula is revenue expenditure minus revenue receipts. So let us see revenue expenditure, what all there are. It is given clearly, 14,36,169. it is given this and this. You can see revenue expenditure, revenue received. If we will subtract it, we will get the answer of revenue deficit. Okay. After that, fiscal deficit. What is the formula of fiscal deficit? That is total expenditure. That is the revenue received minus revenue received plus recovery of loan other than the borrowings or other than the receipts. Okay. Other than borrowings will be coming. So let us see total expenditure. How much is there? Given calculated, it is total expenditure 2 plus 4 given 60,65,297 crore minus revenue received. How much was there? 10,56,331 plus recoveries of loan. How much recovery of loan has been done? Means government had recovered the loan and other receipt, that is 66,467. When we will total up, we will get the fiscal deficit. So this is another formula you note down and you can get. Definitely recovery of loan is a receipt only. For our recovery of loan is given there, that government is recovering the loan which they had given to someone else. Next come primary deficit. Primary deficit, when we say fiscal deficit minus interest payment, if we will do, we will get the primary deficits. Okay. So this is the primary deficit. So this way, student, we will be getting the particular topic, that is one more thing is there. If you have calculated the primary deficit, you can calculate the fiscal deficit, that is primary deficit plus interest payment. Okay. But if we will not calculate fiscal deficit, how we can calculate the primary deficit? So that it is needed that primary deficit has to be calculated. Okay. So this is one of the type of question. Only one question is there in the calculation. If any question in your book, you can solve and you can get the solution for the same. This one question at least you practice so that you can come to know how to calculate the questions of government budget. This chapter is completed. Thank you for today's class. Have a nice day.